Okay, so in this question, we will be considering two new things. First of them is fair value adjustments, what you have to do while you're calculating the net asset value. And the second adjustment, what we have to consider in this question is the impairment of the goodwill. Okay, so now if you can see that in this question, below are the statements of financial position of Peppermint and Spearmint Company as at of 31st of December 2004. Yeah, and they have said that Peppermint acquired 80% of the share capital of Spearmint Company 2 years ago when the reserves of the Spearmint Company stood at 125,000. Okay, so this acquisition has happened 2 years ago. That's on 1st of January 2023. Okay, 2003, when the reserves of the company, the subsidiary, stood at 125. Now, that's the cost of investment information given to you. Peppermint Company paid an initial cash consideration of 1 million. So if you can look up in the parent's balance sheet, you can find this 1 million over here, which is investment in Spearmint Company. However, additionally, Peppermint issued 200,000 shares with a nominal value of 1 and a market value at the date of acquisition of 1.8. So there has been a share consolidation also, and it was also agreed that the Peppermint would pay a further. So that's deferred because they have committed, but they will pay it in future. So that's 500,000 to be paid, like a half a million to be paid in 3 years' time. The relevant interest rate to get this thing into its present value is at 10 percentage. And obviously, the shares and deferred consideration have not yet been recorded, because if it would have been recorded, you would have find it in this amount over here. But as this amount is only 1 million, so that represents only the cash consideration provided. So while you're consolidating the balance sheet, you have to ensure that you do record the share and the deferred consideration. Okay. So now we can also have a look at the further information. It says that at acquisition, the fair value of the Spearmint's plant exceeded its carrying amount by 200,000, and a plant had a remaining useful life of 5 years at this date. So basically, this is the fair value adjustment which I was talking about at the start of the video. We also have for many years, Spearmint have been selling some of its products under the brand name of Mint Fresh. So we have an intangible asset over here, which is under IS 38. As you know that under IS 38, internally generated intangible assets are not to be recorded uh, because you cannot separate them from the business. But in this case, while the parent is acquiring a company, so it's actually putting up a value onto it, and it can be it's been sold separately. Okay, so at the date of acquisition, the directors of Peppermint valued this brand at 250K with a remaining life of 10 years. Now, the brand is not included in the statement of financial position. Obviously, it will not be included because it was an internally generated intangible asset. But under the IFRS 3 business combination rules, while you're consolidating, these internally generated intangible assets of the subsidiary company are recorded in the consolidated financial statements. This is the second thing which I talked about. The consolidated goodwill has been impaired by 258,000. So we have to understand that how we are supposed to record the impairment of the goodwill. The policy for the group to value the NCI is at fair value. They have also provided you with the fair value of NCI, which is at 380K. So it means that we won't be recording only 80% goodwill, but we will also be recording the other 20% goodwill, which relates to the NCI. Okay. And the question is to prepare the consolidated statement of financial position as at of 31st December 2004. So we'll start our workings. The first working would be to prepare the group structure. Okay. Now, group structure would not help you to gain any marks in the exam, but however, it's very essential for you yourself to make sure that you have understood, and it helps you to lay out your workings properly. Okay. So you have the name of the parent company, which is Peppermint Company. The name of the subsidiary company is Spearmint. Okay. Date of acquisition, what we have is 2 years before, so that's like 1st of January. 1st of January 2003, that's 2 years before. And then you also have the percentage of ownership, which is 80, and 20 percentage is your NCI. So once you have prepared the group structure, now you can move towards the next working, which is to find out the fair value of net assets of Spearmint Company at the date of acquisition, which is 1st of January 23, and then as well as at the reporting date, which is at 31st of December 2004. Okay. Now, please try to understand this thing that while you're when you're recording your goodwill, uh, right? It's actually the difference between how much you have paid for it and how much you have got. So in a normal market transaction, when anything is being sold or purchased, you always do the transaction at its fair value, right? So far, like in the previous videos, we didn't talk about the fair value adjustments. We were just taking the book value, the carrying value of your assets and liabilities. But in cases when you have to calculate a goodwill, it's actually the difference between the fair value of what you're paying and the fair value of what you're acquiring. Okay. So the cost of investment is also recorded at its fair value. And likewise, the net assets of the subsidiary which you're acquiring are also to be recorded at fair value. And then the difference, whatever it comes up, is your goodwill in case if you have paid more for it. So the extra amount what you have paid is basically for the goodwill of the company. Okay. So now if you look up at it, net assets, actually, we just have two things over here. We have share capital and we have the retained earnings. Okay, so we have these two things in the net assets for your Spearmint Company. So we have the share capital and then we have your retained earnings. Okay, we can put 1,000 because all these workings are in 1,000. So okay, so share capital, as you can see, it's 500,000 and retained earning is 300,000 at the reporting date, right? So we'll put this 500 and we'll put this 300 and we can get up to a total of 500 plus 300, which is 800, 800,000 worth of net assets at the reporting date. For the acquisition date, what we have to do is we just simply take the same share capital. However, the retained earnings were given to you over here at 125. So either it says reserves or it says retained earning. It's exactly the same thing. So 500 plus 125, you get a total of 625 over there. So 500 plus 125, you get 625. No, but this is actually the book value. Okay. So we need to write down a heading over here, which is considered to be as your fair value adjustments. So the first fair value adjustment, what you have is regarding the plant. Okay. So when we acquired the subsidiary, Peppermint Company acquired the subsidiary, um, the only asset which exceeded its carrying amount was plant by 200,000, right? So you need to adjust 200,000. So when you increase the value of the asset, your net asset value will increase. On the other hand, it could be that the fair value has gone down. So in that case, you have to reduce the value of the net asset. So be very careful in the question that is it exceeding or is it going down? Okay. So in this case, what we have is that it's exceeding. So in that case, we have to increase our net assets by 200,000. So we'll write down over here plant and we have to increase it up by 200,000. So the net asset value will increase. So if it's increasing at the acquisition date, definitely it will also be reflected at the reporting date, right? Now, if you see further, it says the plant had a remaining useful life of 5 years at this date. Okay, so now because you have increased the value of the asset, it will count for extra depreciation, excess depreciation, right? Because if the value of the asset has increased, so it means that I have to also incorporate for the extra depreciation. Now, when you depreciate an asset, your asset value go down, and likewise your net asset value will also go down. So in that case, now we have to calculate our excess depreciation, but you need to understand that it will not affect your workings of net asset at the acquisition date. However, the depreciation is charged after the acquisition, so it will only affect your reporting date. Okay, and you need to understand that, see, uh, it's very necessary to work out on the group structure first, because right now you do understand that the acquisition has happened 2 years, so I have to account for 2 years depreciation. Okay, a lot of students will just calculate the depreciation for 1 year and they will just charge for 1 year, which is wrong. You need to understand, you need to make sure before you start your workings that what's the difference between the acquisition date and the reporting date, basically. So now in this case, you can see that 200,000 is what we have increased the value of the asset by. The remaining life at the date of acquisition was 5. So if you divide 200,000 by 5, you will get 40,000, which is the depreciation per year, right? But because the difference of the acquisition date and the reporting date is 2 years, so I need to multiply it by 2, and I will get a total depreciation of 80, which has to be charged over a period of 2 years. And hence, that will reduce the value of the net assets at the reporting date. Okay. So once we have completed this fair value adjustment, we need to go on the second point, which says for many years, the company subsidiary has been selling goods under a brand name, which is an intangible asset. And at the date of acquisition, the directors of Peppermint valued the brand. So this asset will also be recorded because the parent company is paying you for all of your assets. Okay. So in this case now, we have to write down brand value over here. The fair value what they have put is at 250. So again, this will increase your net assets both at the acquisition date and as well as the reporting date. Right now, likewise, you charge depreciation here, it has to be amortization. Now, this is not an excess amortization, but in the first place, because the asset was not been recorded in the statement of financial position of the subsidiary. So, over the period of 2 years, we have to record an amortization for 2 years, right? So, for the amortization, okay, it has to be see it the life is 10 years, right? So we have to do 250,000 divided by 10, so that makes 25 into 2 years, right? So that makes it up to 50. Okay. So once you have done the fair value adjustments, okay, then you can sum it up, and those are the values which you will be using for your goodwill, NCI, and your retained earning calculation, which is working 3, 4, and 5 respectively. So in this case, now we get a total of 625 plus the fair value adjustments, which is 200 and 250. Okay. And here, so the net assets at the acquisition date is at 1075, and that is the figure which we will be using for your goodwill. But on the other hand, for the at the reporting date, you have 800. Net of this is 120, so 200 and minus 80, you get 120, and then 250 for the brand, and adjusting for the amortization of 50. So the final what we get is 1120, and this value will be used while you're calculating the NCI value, right? The difference between them is 1120 minus 1075. So you get 45, and this would be used to calculate your group retained earnings. Okay. Now, once when we have find out the fair value of the net assets of the subsidiary at the acquisition date and the reporting date, now it's time to move to the next working, which is working number 3, and we have to find out our goodwill. So in order to find out the goodwill, first we have to work out on your cost of investment. Okay. And as you know, we read at the start of the question that it is made up of three things. You have cash consideration, you have shares consideration, and you also have your deferred consideration. Now, cash consideration is quite obvious. It's already given to you in the question at 1 million. Okay. But then you have your, uh, so I'll write down 1 million over here. But for share consideration, they said directly to you in the question that the parent company has issued 200,000 shares at a market value of 1.8. Likewise, if I have taken my net asset at fair value, I also need to take my cost of investment at fair value. So this will be around 200 into 1.8. So that will give me 316. For deferred consideration, I have to pay half a million, 500,000 after 3 years, right? The Peppermint Company has to pay 500,000 in 3 years' time. So now 2 years have already passed. So you do understand that this should now be classified as your current liability. Okay. Because by the next year, you have to pay it. This, they promised it 2 years before that they will pay it in 3 years' time. So now it's the last year left. Anyways, so 500,000 and the discount rate given to you is at 10%. So we need to find out the factor, the discount factor. We'll multiply it by half a million and we're going to get the present value of that. So in that case, so you can see that the fair value of that 500,000 which we have to pay after 3 years in today's term is what we will calculate right now, right? So 500,000 into the factor which is 1 divided by 1.1 to the power 3. So the factor would be 0.751, I believe. If you multiply it by 500,000, so you basically get 375.6. So I'm just going to round it up and we get 376. Okay. So in this case, the total cost of investment is 1,360 and 376. So the total cost of investment turns out to be 1736. And now, as you have already, so that's what you have paid for it, right? But what you acquired, the fair value of that net asset is 1075. But you do understand that it's not like the whole company you have acquired, you just have acquired 80% of that, right? So we will say less parents share in fair value of the net assets of the Spearmint Company at the date of acquisition. So in that case, it's going to be 1075 into 80%, and you get 860. So what you have paid in extra is 1736 minus 860, and you get there a goodwill of 876, which is the controlling or the parent's share of the goodwill. Now, so that's what we worked out for your 80%. So I can just write down over here that this working was for 80% the controlling interest. Now, for the next 20%, which is the non-controlling interest, for instead of writing down the cost of investment, we have to write down your fair value of NCI. Okay. So if the NCI is sold in the market, it will have a fair value of 380K, right? But the NCI share in fair value of net assets of Spearmint company at the date of acquisition. Okay. So that is 20 percentage. So we have to take 1075 into 20 percentage. So we get 215. So in this case, the goodwill, which is attributable to the NCI, is 165, right? So the total goodwill at the acquisition date will be a total of 876 and 165. Now, so that's a total of 1041. But now, as you can see, that the goodwill has been impaired by a certain amount, which is by 258,000. So you have to be careful in the exam question. Like, obviously, if you're making the balance sheet, I don't need the goodwill at the acquisition date. I need the goodwill, which is after the impairments, right? But in an MCQ based question, you might be asked to calculate the goodwill at acquisition or the goodwill at the reporting date. So be careful that what exactly has been asked to you in the question and answer accordingly. So in this case, we have to say less impairments to date. So in that 2 years, the total impairment which has been charged is 258,000. So I'm going to subtract 258,000 from here, and that will be the goodwill which I need to report in my balance sheet, in my consolidated balance sheet, which is at 783. Goodwill at the balance sheet date or the reporting date. Okay. But once you have done this, there's one slight adjustment you need to put up over here. So this is the 80 percentage goodwill and this is the 20 percentage goodwill, correct? So this will be your goodwill at the acquisition date. So that was here 876, and over here for the 20 percentage it's going to be at 165. Right, now we do have an impairment over here, right? So the impairments what we have, as you know, in total it's 258, but from that 258, 80 percentage belongs to the controlling part and 20 percentage belongs to the NCI. So 258 into 20 percentage. So we have to prorate the impairment between the controlling part and between the NCI part, because the impairment chart which is towards the controlling interest will have to be recorded. Okay, so as you can see that we have prorated the impairment between the controlling interest and the non-controlling interest, because the the impairment share which belongs to the controlling interest will have to be recorded in the group retained earnings later on, and this one will be a part of the NCI value. Okay, so this will not be recorded in the group retained earning. That's the reason why you need to segregate between the parent, between the controlling and the non-controlling part, right? So we get here a goodwill of like the goodwill after the impairment, which is this. After the deduction of impairment, we get a goodwill of 669 for the controlling part, and then we get 113 for the non-controlling interest. Yeah. Okay. So now moving further, once we have figured out our goodwill, now it's time to calculate your NCI. For this, you have here working number 4, which is non-controlling interest. Okay. We have to take the value of the net assets, the NCI share in the net asset, and then the NCI share in the goodwill, which is after the impairment. So you see for the net asset, as I told you above, that we have to take this 1120 and we have to multiply it by zero point 0.2, which is the NCI share, 20 percentage, right? But for then the goodwill, we already have this figure over here, which is 113. So because your workings are straight, set out correctly in a straight manner, you just have to follow the steps actually, and then you don't have to worry about. So 113 here. So the total value of the NCI is 224 plus 113. So that makes it up to 337. Okay. Then in that case, now we have to move towards the next working, which is working number 5, and that will be your group retained earnings. So when you're calculating your group retained earnings, first you have to take all of your retained earnings, like 100 percentage of the parent group retained earning, which is basically given to you in the balance sheet at 1400, right? But then you have to take your share of the retained earnings after the post acquisition period. So that's going to be from subsidiary share of post acquisition retained earnings. Okay. So that is going to be 45 into 80 percentage, and we get 36. So after you have done this, you can add them together, which is 1436. So you will get a total of 1436. But here comes the new part. Okay. There are two things which you need to adjust from the group retained earnings. The first one is obviously the goodwill impairment, which is your share. I mean, the parents' peppermint's share in that case, which is here. We already did it, which is 206.4. Okay. That's the first thing which you need to adjust. Then the second thing what we have is the unwinding of discount. Now, be very careful that the date of acquisition and the date of reporting have a difference of 2 years, right? So, though if you're making an income statement, you just have to take the relevant expense of that current of that year. Okay, so I would have taken the expense of the second year then. But in this case, because I'm making up a balance sheet and I'm representing my group retained earning, so all the expense of 2 years will have to be recorded so that I can get my final group retained earning by the end of the second year. Okay. So unwinding of discount, we have to do it for the first year and then the second year. So it has to be collectively for the 2 years finance cost expense. So for the first year, it has to be the present value which we calculated was 376, I believe. Yep. And we have to take 10 percentage of that. So that's the interest expense for the first year. Okay. And we can just simply round it up, right? But then for the second year also, see, the value was 376 at the opening when you acquired the company, when Peppermint company acquired the Spearmint company. Then over 1 year, you increase the liability by 38. Like you unwind the discount by 38. So the value of liability by the end of the first year was around 414. But on that 414 for the second year, again you have to apply a 10 percentage interest. So it will become 41 for the second year expense. So total finance cost or the total increase in the liability in these 2 years have been around 79. You can see 38 and then you can add up 41. So that is 79. Okay. So this is all going to be subtracted from the group retained earning because it's an expense. So that will reduce your group retained earnings. Okay. So Okay, just 1 second. All right, so we can adjust this in formula. So the group retained earnings would be 1436, then minus your goodwill impairment, and then minus your unwinding of discount for the first year, and then also for the second year. So this will give me a final answer for the group retained earnings at 1151. Okay. So now once we have completed all our five workings, we have to prepare the consolidated balance sheet, right? So here it's going to be your peppermint group. Okay. You have to put the thousands, right? Just a little bit of presentation. Okay, so now for property, plant and equipment, you see you have to add up obviously the parent's property, plant and equipment, and then you have to also add up your subsidiaries property, plant and equipment. But now that's the new thing which we have to do over here, that we need to adjust for the fair value adjustment. So if you remember that we increased the net assets by 200, but then we also reduced it by 80 for the excess depreciation. So by the reporting date, we need to make up a net adjustment of 120, which is 200 minus 80. So that will become to 120. So total property, plant and equipment to be recorded in the consolidated statement of financial position will be 7120. So I can write down here a formula for you, which is parent property, plant and equipment plus subsidiary property, plant and equipment. And then you have to do the fair value adjustments minus the excess depreciation. So if you remember this formula, it could be quite easy for you to tackle an MCQ or Section C constructed response type of questions. Okay. But in this case, now see that we also have to record a brand, an intangible asset, right? So we need to include that intangibles, which is going to be again, there was a brand and it had a fair value of 250, but then we have to record an amortization of 2 years, which is 50. So that will make up a net of 200. Okay. So remember that any assets which were not recorded have to be adjusted now. Right? Now, this investment and experiment company, this 1000 would have to be cancelled with the share capital and the retained earnings which stood at the date of acquisition of the experiment company. And in that case, it will turn out to be a goodwill. So for goodwill, we just simply have to bring the value from our workings, which was after the impairment, and that's 783. Okay, so that's all for your non-current assets. Now we have your current assets, but for current asset, we just have to add up the one which is for your parent company and the assets, current asset, which is for your subsidiary company. Okay. Likewise, we can also do it for your receivables and cash. So I'm just going to use Excel and that's it. So we got the current assets. You can have a total for your non-current asset, which is 7120, 200 and 783. And then you can also add up your current assets, 650, 600 and 200, 250. And you will get your total asset, which stood up at 9603. Now it's for the equity. For equity, as you know that the share consideration was not being recorded. Okay. So 2000 plus the number of shares which have been issued were 200. They have a nominal value of 1, but then they have a market value of 1.8. So that 0.8 is considered to be as a premium. but that $1 will be regarded as an increase in your share capital. So that is 200 into 1, so that is 200. So total turns out to be 2200. But here for the share premium, you have to do 200 multiplied by zero point 0.8. That's the difference between the market value and the nominal value. So you get there a premium of 160. For group retained earnings, you just simply have to take it from the workings, which was 1151. Once when you have done with the retained earning, you have to include your NCI value, which again we have to just simply take it from our workings, and the NCI had a value of 337. Okay. Now it's all about non-current liabilities. In this case, the deferred consideration, which has not yet been recorded, is basically not a non-current liability. It will be classified as a current liability because it's only like after 1 year you have to pay it off. The group has to pay the parent, right, to the investors of ex-investors of your spearmint company. So in this case, for non-current liabilities, I don't have to worry. I just will take 3000 and I'm going to add up 400, and that's the end of it. But for current liabilities, yes, I do have to add up my deferred consideration. So I'll take 1250 plus 650. Okay. My deferred consideration initially was to be recorded at 376, but over the period of 2 years, the unwinding which I have done is 79. I already had the total for you over here, because in first year you record the expense by 38, and then in the next year you record the expense by 41. So it has increased by 79 over the period of 2 years. So that gives me to a final answer for my current liabilities at 2355. You can write down over here a note including the deferred consideration. Okay. And now if you total them, you should supposed to be get a total of 9603. So 2200 plus 160 plus 1151 plus 337 plus 3400, and then plus 2355. So this gives me a total of 9603. Hence my balance sheet is tied. Okay. I hope that's all clear. Thank you very much. If you have any questions, please feel free to leave a comment, like, and subscribe. Thank you.